How's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group. And today's topic, I want to discuss with you retirement life insurance and fully explain the pros and cons regarding how you could utilize a permanent life insurance plan, the cash value that's involved with that type of permanent life insurance policy to leverage for a supplemental retirement income later on, or just an additional retirement asset later on, and kind of explain the accumulation, how to reduce some of the negatives regarding those types of accounts that unfortunately individuals have experienced. So the problem lies that individuals go and they're pitched this amazing idea that they could have death benefit coverage and retirement asset accumulation coverage and tax-free income at a later date and time. And you have to really understand the cons or the inner workings of how a permanent life insurance policy works, so that you could accentuate that cash value maximization growth, and try to strip away all the costs associated with that plan. So what do I mean by that? Well, if you have an individual that goes and they think that they're placing dollars into a permanent life insurance policy, well, understand, kind of look at this little egg shape and understand, if they're placing dollars into this plan, you have a large portion that's going into the cost of insurance and different miscellaneous expenses, and a portion that is above that amount goes into something known as a cash value. So that cash value is kind of like a savings account. So what happens is individuals will get set up onto a type of life insurance plan with a very high death benefit that's associated with that plan. If somebody has a death benefit of $1 million or a death benefit of $500,000, well, the $1 million policy is obviously going to have higher costs than the $500,000 plan. For an individual that's looking to have cash value accumulation and wealth accumulation within these types of accounts, their primary focus should be to make sure that that death benefit is as small as possible. Reason being is because for every dollar that you're placing into this contract, you want to try to accentuate this growth and make sure that the cost of insurance and all those miscellaneous expenses are as tiny as possible, so you have as large of a net amount going towards that cash value, towards that savings account aspect. So if we talk about this cash value, what are some of the things that increase that cash value? Well, we understand if we're placing a dollar amount into this plan every month or every single year, the more we strip away these types of costs, the negatives to this plan would obviously grow that cash value, because then you're having more and more dollars being placed into that plan every single year that you're placing contributions. And then on top of it, you want to have this cash value linked to a specific interest credit. So the way that the interest credit works is it could either be a fixed type account, it could either be tied to interest rates, it could be tied to mutual funds, or the one that I like in particular is tied to a specific upward market index. So if we understand kind of the negatives to these types of accounts are, if you're throwing too many dollars towards those costs, well, then you're not going to have a good cash value accumulation in there. Why is cash value important? Cash value is important because if set up the right way, you could accentuate your growth within that account, meaning that every year that your cash value is growing, meaning the amount of net that you're netting beyond those expenses is going to add to that bucket. And then also, if you're receiving positive interest gains into that bucket, the combination of those two aspects are going to have higher and higher cash value accumulation year by year by year. So what are some of the benefits of cash value, of why somebody might want to maximize out that cash value? And it goes to, if set up properly, you could have tax-free growth. You could have a tax-free income on the back end, meaning whenever you're ready to retire, you could pull money out of that. You could take money from that cash value 100% tax-free. And then also, if you pass away, whenever you pass away, you could leave a tax-free death benefit to your loved ones. Now, to go off of that death benefit aspect, understand that there's something known as a cash value corridor, meaning that you can't just throw 100 grand into a policy and then have a $1,000 face amount into that same plan. What happens with that is it's known as a modified endowment contract, and it's essentially a penalty when you overfund the policy too much. So you have to make sure, if you're placing in X amount of thousands of dollars in cash value, there has to be a complete correlation to the amount of death benefit that's in there. So that's why if someone's placing in 20 grand a year into a type of permanent life insurance policy, well, that minimum death benefit might be $1 million, But if they're placing $10,000 into that plan, the minimum death benefit might be $500,000. So what we're trying to do is make sure that you're getting set up the right way, that we're reducing that death benefit to its bare bone minimum. Because if we reduce that death benefit, then that's how we're able to strip away the costs. So as I clear off the screen, rather than have a plan that you have the premium dollars going into this little egg shape and having the cost of insurance and all those miscellaneous expenses that high and a small portion going into that savings account, that cash value aspect, what we want to do is set up policies where, if we look at that same, I apologize for the sloppy handwriting, the same egg shape of the cost of insurance and the different net amount at risk and the different expenses are going to be as low as possible, so that that cash value is going to be accentuated as much as possible, so that we're adding cash value growth in two aspects. The number one aspect is trying to strip away the costs and the fees as low as possible, but making sure that we're not triggering off a modified endowment contract. So when you set up these plans, life insurance, utilizing a permanent life insurance plan or a cash value maximization plan could be set up in an unbelievable way. Unfortunately, majority of the times advisors try to set it up to make sure that they're accentuating out their commissions, making sure that they're adding to those costs, adding to all those expenses, adding to the death benefit, so that they could be paid, in a handsome return. What we try to do is set up these plans properly. We try to make sure that if your main goal is to set up a cash value maximization plan, and you say, I want to place $10,000 into this plan every single year, well then, based upon what your age is, there's going to be a minimum amount of death benefit that we could make sure that we're placing that to the bare bones minimum, so that we're overfunding the heck out of that policy. What that's going to do is accentuate the cash value, and then because that cash value is going to be accentuated, now we're going to have different factors on how we could pull out that cash value and make sure that we're growing that account. All growth within that account is going to grow tax-free. And when you try to pull out this money for income, for retirement income, is going to come out tax-free. The number one mistake that individuals make is just going to a random company, seeing a commercial on their television or hearing a radio advertisement and saying, "Oh yeah, I heard about this company. I just want to go and throw all my money with them," because you want to make sure that it's specific. If you're a specific age, if you have a specific income goal or an accumulation goal, and you want to place X amount of dollars aside per month or per year, you want to make sure that every dollar is being accentuated into that cash value accumulation, so you could leverage that cash value for a later date and time. Now, majority of the times whenever somebody calls into our office, their 1-800 number is 1-800-566-1002. We offer 24/7 customer service. Depending upon your state, depending upon your age, depending upon your health, depending upon how much money you're looking to place into these plans, it has to be set up in a very specific way. So this is not something to be taken lightly. It's not something to just say, oh, I want to throw all my money into this one program. You want to make sure that we're going through hundreds of the top carriers. Whichever carrier is going to give the best possible solution is going to be our recommendations. And we could show you the different pros and cons and explaining, okay, listen, I understand that you like company XYZ, but it might not be most beneficial for you. Even though we can represent company XYZ, there's many times that we have to explain and educate to our clients that this might not be the best way forward, because of the fact that you're throwing way too much money towards those costs of insurance, towards those miscellaneous expenses, than the other company ABC that's going to put you in a lot better situation. So in closing, what I want you to do is just understand that retirement, utilizing life insurance, a cash value maximization plans for retirement planning, there is a very simplistic process on how to do it. You just want to make sure that you're avoiding the mistakes at all costs. We set up an entire process. It's known as the Retire Sharp Planning System, the RPS. What it does is, for each individual that calls in, they say, hey, listen, I'm interested in retirement life insurance. I'd like to speak with a specialist. You'd be patched over to that specialist. We offer 24/7 customer service. It could be Saturday, Sunday, mornings, nights, whatever that is. We'll always have a specialist standing by because of our national volume. And that individual will go, it'll be, specific to your area and specific to the plans within the area that you're calling in, and he will try to educate you first and foremost. During that first conversation, you're going to be very comfortable. You're going to explain, what are the goals that you're trying to really accomplish, and then from there, the a representative is going to try to educate you best way possible and say, hey, listen, this might not be a fit. You might not want to utilize life insurance as a maximization plan. But with a lot of those instances, when you're really delving into the pros and cons, it does make sense for the correct individual. When that happens, you want to make sure that you're being set up with the correct company. So with this Retire Sharp planning system, on average, whenever someone calls in, we go through over 1,200 different contracts and scenarios, strategies that are proprietary to Fosse Financial Group before we make our top 3 recommendations. So, I want to thank you very much for watching this video. Feel free to subscribe to our YouTube channel, Retire Sharp, so you have access to the most updated videos. And just, whenever you're looking at a situation, understand the company that you're going to be placing your dollars into, they're going to try to make a profit. What you have to do is make sure that you're going through all the BS, all the smoke and mirrors effect of these companies to say, if I'm placing a single dollar into a plan, I want to make sure that my dollar is maximized the best way possible. And that's one of the things that we try to do is make you, get you from point A to point B successfully for your retirement destination, and make sure that you're eliminating those negatives, the best way possible. So thank you very much for watching this video. We look forward to speaking with you, and look forward to hearing your feedback when calling in the 1-800 number, 1-800-566-1002. Thank you so much.